Okay, what's up everyone? So this is Training Grounds episode 6. We will be talking about risk management today, plus a bit about funded challenges because I've been getting some comments. But I thought we could link two and two together and basically kind of explain risk management to you guys because most of you will start on demo. And I want you guys to start on demo and then you can move on to funded challenges after you trade on live with like $100, $50, whatever. So it would just be like 3 months demo, 3 months on a live with your own money, and then you can pass a funded challenge by then. So risk management. What is risk management? Risk management is basically for you to not lose money. You manage your risk, how much money you are risking on a trade basically. So if you have $100 and you want to risk 1%, your risk would be $1. So if you lose, you only lose $1. So until you lose your account, you have 100 trades. If you lose 100 trades, you should probably go do like dropshipping or whatever. Because if you lose 100 trades in a row, I think you need more practice on demo, bro. Just go back, okay? So risk management is basically managing the amount of money you will lose on a single trade. And I always say you should risk 1%, but if you have like $100 you want to trade with, you can do 10% risk and you lose $10 on a trade, or you win $10. Or if you aim for like more reward, you can do like $20, whatever. But I don't think you should trade with $1 1% on a $100 account. If you move on to like a $5,000 account on a funded, you can do 1%. It's $50 after all, so that's not bad. 10K account, $100, 25K, 250, blah blah blah. But yeah, I suggest using 1% risk, so you lose 1% of your account if you lose a trade, and then you win however much you want to do, what you're aiming at, what you're aiming for, whatever. So it's just basically preserving your capital and you're not over risking. So let's say on a funded challenge you have an 8% overall drawdown and a 4% daily drawdown. If you're in a 10K account, that means you have a $400 cushion of losing that day, and you can lose $800 overall. If you risk 0.5%, you have an 8 trade cushion on your daily drawdown. If you risk 0.5%, you have a 16 trade cushion basically to use. So risk management is just about preserving your capital. So how do you actually use risk management? You take your account size, you divide it by 100, and there you go, that's your risk. That's how much you can lose in a trade. So why is risk management important? I talked about how on funded challenges there's like a drawdown rule. You don't want to exceed that because then you blow your account and you're finished. And you're maybe like, well, it's difficult to lose like 8 trades. Yeah, but if you maybe fuck up something and you don't put a stop loss, you can easily blow the whole account in like one single trade or in like 2 trades, whatever. So always know your risk. Always use a stop loss because market may just reverse or reverse like this, whatever. Moving on, we can get back to risk management later, but that's basically the introduction of risk management. In tomorrow's video, I think I'll show you guys on the charts how to kind of do risk management, how you can calculate everything. But I mean, it's pretty easy on most platforms. You can just drag your stop, whatever you want to do. So let's move on to funded challenges. What is a funded challenge? It's basically a challenge for you as a trader to prove that you are profitable for a prop firm. Next question is, what's a prop firm? It's a company that will offer you like digital money. Basically, it won't be actual money you can withdraw from your account, but they offer you a virtual account which you can trade with on the selected amount that you pay for. So for example, like $100,000, and you need to pass a challenge. It can be 1, 2, 3 steps. There's also instant funding for which you don't really need to pass a challenge. You can just trade on it. but the rules are much tighter. The profit split will be like 50-50, not 100. So they will keep most of your profits. Basically, that's the whole thing of it. Why it sucks. But if you can be consistent for like 6 or 7 or 8 payouts, you can actually go up to like 80-90% profit split, which is good. So what is a profit split? Well, a profit split is basically in its name. If you make $100 on that account that you are funded with, you will get the amount of money that is in the profit split. So if it's a 90-10 profit split, that means you get 90% of the $100. So you get $90 and the profit firm keeps $10. You can have like 50% on live funding account. You can even find profs with 100% profit split, but that's basically profit split explained. So how do prop firms actually make money? Well, first of all, they make money by you paying for their accounts, and like 90% of traders fail their funded accounts, like the first few at least. There are very few people that will pass their fundeds on their first try, basically. You pay for the challenges, they get the money, they give you an account. You fail that, they keep the money, that's it. But if you pass the account, how will they actually pay you out? Well, there are lots of people buying challenges, so that's one way they can pay you out. But if they don't have 10,000 people paying for their fundeds, they cannot pay you out like $20,000 on a 200K account, which is crazy. But there are withdrawals that big and even bigger that I've seen. You can check on FTMO, which is a good prop firm, a really good prop firm, very respected prop firm. Their leaderboards and their biggest withdrawals. So what's another way they make money off of you? Well, there are two models which a prop firm operates with. It's either an A-book firm or a B-book firm. So A-book firms, they give you direct market access. So you send them their order, so they will fill that order in for you live on the markets, for example, on Skilling or 8cap, CMC markets, forex.com. Whichever these markets they operate with, they will fill in that order for you and you get direct access to markets. So your trades will move just like any other trades on the market would move. And they make money by you paying the fees for it on your account, which is kind of hard to explain, but they will take a fee from your account on every single trade, and then they are good with that profit because they fill the order in for you in the markets. Technically you pay the markets that price, but then when you close the position they actually get that. The other model is the B-book model, which is kind of the dodgier side of the whole prop firm companies. So they take your order and they have their own platform. So you launch a trade that goes in their system. Then if you take a short position, they will fill in an order for themselves. So they actually fill your order in, so they take a buy position. So if you lose your trade, they win that trade and they make money off of that. And if you are a profitable trader, you will usually get moved onto the A-book model. So they will actually kind of fill your trade in with the markets, but then they also take the same position of you. So if you sign a contract with like FTMO or TopStep, they will take the same trades as you do in the markets. So that way you can make money, they can make money, and they can actually pay people out and not be stuck in a loop where they cannot pay people out for 6 or 7 months. We've heard of prop firms like that. Cannot name drop because I will get sued for defamation even though I have 30 subscribers. So I will see you guys again tomorrow with the strategy video. I'll try to keep it as consistent as possible. Today I will probably record like 2 episodes as well. So on the weekends I can upload them for you. But this is going to be it. Peace out.